Welcome back to Financial Fortitude. Today, we're diving into a topic that can be a real game changer for your retirement strategy, Roth conversions. If you've ever wondered how to turn your tax-deferred retirement savings into tax-free income for the future, this episode is for you.
That's right, Michael. Roth conversions are one of the most powerful tools in financial planning, but they can also feel very overwhelming. Questions like, how much should I convert? When's the best time to do it? Or even, should I do it at all? Can make it tough to know where to start.
Our goal today is to make Roth conversions easy to understand and actionable. Here's what we'll cover: how Roth conversions work and what taxes you might owe, when it makes sense to convert, like during low-income years or market dips, the benefits and risks of this strategy so you can decide if it's right for you, plus real-life examples and common mistakes to avoid.
Whether you're thinking about converting now, in retirement, or just curious how this fits into your overall plan, we'll guide you through everything you should consider. So grab a pen and paper or just sit back and listen as we help you master Roth conversions and set yourself up for the potential of greater tax-free income in retirement. Let's get started.
Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We are your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in.
Brady, I'm super excited to talk about this topic with you today because it's very timely now that we're getting near the end of the year. The topic of Roth conversions is something that can really take place at any point in time in the year, but we more often will see it around the fourth quarter, right before year end, because earners, professionals can see how much income they've actually earned and can recognize whether or not they're going to be phased out. Now, before we get into the topic as a whole, give us a little bit of brief overview around what a Roth IRA is, and let's kind of peel back the onion on how that ties into a Roth conversion.
Sure. So I think the easiest place to get started is just doing a very brief overview of the differences between a traditional IRA and a Roth IRA. For individuals who aren't familiar, a traditional IRA is a retirement account where essentially you are storing and stocking money away for your future, for retirement to provide income for you. And as you are making traditional IRA contributions, you can actually deduct that income from your tax return. Very simple example, if I make $100,000 this year, I put $5,000 into a traditional IRA, the IRS treats me like I only made $95,000, right? I get an immediate deduction or a write-off this year. A Roth IRA is a little bit different in that I don't get any deduction this year. If I make $100,000 this year, I contribute $5,000 to a Roth IRA, the IRS treats me as if I made $100,000. Now, the difference between the two is as they are growing tax deferred, right? No taxes year over year on your retirement accounts. When I go to retire 20, 30, 40 years from now, all of the money that comes out of the traditional IRA, I pay taxes on. All of the money that comes out of the Roth IRA, I do not pay taxes on. And that can be very meaningful for someone who's retired or is now drawing against the accounts that they've saved and invested.
Gotcha. So there are two types of IRAs, right? An IRA really just stands for individual retirement account. So if you have earned income, earned wages, you can go and open up an IRA yourself anywhere, or if you work with an advisor, they can help you establish one. Throughout the course of the year, you have the opportunity, based on how much income you earn, because there are limits that you need to reference, you can make contributions either pre-tax and receive a deduction in that given year if you contribute to the traditional pre-tax IRA, or you can contribute after-tax dollars towards a Roth IRA. Both accounts are going to grow tax deferred, meaning that any growth that you experience in those accounts, you will not have to pay any taxes on until distributions. Right now, the big caveat there is that with the Roth, all of your deferred growth is supposed to be tax exempt, tax-free when you start taking distributions.
Very much correct. And I think that's what's going to drive most of our conversation behind this idea of Roth conversions. So share a little bit with us and our listeners ultimately how a Roth conversion is different than simply making a Roth IRA contribution.
Yeah, so a Roth conversion is the act of taking dollars that are already in a pre-tax account, right? So a pre-tax IRA, traditional IRA, and simply moving them into a Roth IRA, right? Through the form of a conversion. So you're converting it. Now, when that conversion takes place, the individual is going to be required to pay taxes on the amount that's converted because that dollar amount that you decide to shift from your traditional pre-tax IRA to your Roth IRA is going to be treated in that specific tax year as taxable income. Okay, and we're going to talk about an example or two here near the end of today's episode, just so that you can really hear or try to visualize what that shift in potential tax liability might look like for anyone who's thinking about conducting a Roth conversion. Now, the reason why Roth conversions are such a hot topic in today's financial world is, in my mind, because they're relatively young. They're still very much in their infancy. So give us a little bit of background on that, Brady.
So for background, the traditional IRA or the traditional 401k as we know it was created in September of 1970. So for most baby boomer clients, for any Gen X individuals, for any millennials, right, they have existed in this world of pre-tax contributions, deferring taxes until later. But the Roth IRA was created in 1997. So for any of our boomer listeners, for any of our Gen X listeners, it wasn't something that they were familiar with for quite a while and has really only begun to become the craze in the financial world, this idea of a tax-free future. So I see them as, number one, younger, and then number two, we're kind of really getting to this space in the financial planning landscape where we are now working with both traditional IRAs and Roth IRAs for individuals who are retiring. And it's a different story for a traditional IRA holder versus a Roth IRA holder.
And in my mind, it's similar to just the evolution of cars, right? So, we started with wagons and carts and horses, pulling them to, transitioning into where we are today, where we have automobiles that are powered by fuel or electricity, right? More efficient. Roth IRAs are, in some instances, a more efficient vehicle for accumulators or retirees to save or take distributions from, just to better manage their overall tax situation. And we're going to continue to dive into that deeper and deeper.
So what do you see as the why behind Roth conversions or Roth IRAs being a powerful tool as you think through retirement or just longer-term financial planning?
Yeah, I think the biggest value add or the biggest efficiency there is the reduction in future tax liability, right? Historically, we're in relatively lower marginal tax rates. And for anyone listening, there's two types of taxes that we want to at least reference or be mindful of every year. We want to be mindful of our marginal tax rate as well as our effective tax rate. One is what's published by the IRS as far as the marginal tax rates go, the different breakpoints based on your earnings and your income. The effective tax rate is the weighted average of the different breakpoints that you hit based on your earnings. Or another way of saying that is the actual taxes that you paid in relation to the amount of income that you earned, the taxable portion. Okay. And so fast forward to where you're no longer working, if you could pull money from an account that you've been saving in for an extended period of time, and that be 100% tax exempt or 100% tax free, just think about how powerful that is for you. Owing very little money to the IRS during a period of time where you're on fixed income, and one of your biggest risks is longevity, running out of assets, running out of money to fuel your lifestyle and your desirables and your needs. Another one would be just overall sequence of return risk in the sense that, okay, well, if I'm a retiree and I have a health scare, right, some sort of long-term care event that occurs where I cannot complete 2 out of the 6 activities of daily living, that plus any sort of market pullbacks can really deplete my pre-tax assets. On top of that, plus having to pay taxes whenever I take a distribution from that traditional pre-tax IRA. Yep. And that's something that's often overlooked is like, hey, yeah, this year I'm going to make a pre-tax contribution. I get a tax deduction today, which is awesome because nobody wants to pay more taxes than they have to. But all you're doing is kicking a tax bomb down the road. Hopefully your account balance is doubled, if not tripled, by the time you retire. And now you're taking distributions to support your current lifestyle. And guess what? 100% of that distribution is taxable if it's coming from a pre-tax traditional IRA.
Yeah, I think that's a big call out. And one of the things that we oftentimes tell our clients is our job as financial professionals is to help facilitate a conversation with ultimately future you, right? It is your financial professional's job to have a conversation 20 or 30 years from now and ask questions like, what would you like your tax ride to be like? What would you like your retirement risks to look like? And when it's time to start pulling income, the question that we ask most people is, would you rather pay more? Would you rather pay less in taxes? Everyone always says, I'd rather pay less in taxes in the future, right? So how do we facilitate that? one of the big planning tools there is making Roth contributions early. And then for individuals who already have traditional IRA balances, making conversions early in our working years.
And the last piece that I would add from an efficiency standpoint with the Roth IRA is that it's a great legacy transfer tool, right? If you're an individual and you have children or you have grandchildren or great-grandchildren and you want to leave them a legacy or some sort of wealth that you've accumulated upon your passing, leaving them a pre-tax traditional IRA is less efficient than a Roth IRA if it's going to be a retirement account. Reason being, as you pass away and that asset transfers to a child or some other relative that's not a spouse, they are now subject to the 10-year distribution rule, meaning that they are required to fully distribute that account into their own name and out of an inherited IRA over a 10-year period of time. Now, what that could result in is the recipient, the benefactor, having to pay more in taxes and really erode the assets or wealth that you're leaving them. Now, with the Roth IRA, if they inherit that, they're still going to have to distribute it over 10 years. However, again, there's no tax liability tied to it. So if you were to leave them $100,000 in a Roth IRA, they truly have $100,000 to distribute over the 10-year period.
Again, conversation with future client. Hey, I'm looking or interested in leaving money behind for a family member. Would you rather have that money be taxable to them or tax-free to them? Right? The question or the answer, is oftentimes, I'd much rather be tax-free. How do we do it? Putting more money into our Roth IRAs now.
Now, let's talk about how the conversion actually works in a little bit of greater detail. I gave a very high-level breakdown of what a conversion actually is, but give us some more details on how this actually works in practice.
So the first detail that's important to note is you have to have money in a traditional IRA or traditional 401k, right? And oftentimes we run into this conversation with a lot of the individuals we work with as they say, well, I'm already contributing to a Roth IRA and I'm contributing to my Roth 401k. That's great. But the joke that we oftentimes share with clients is nearly everyone we work with has a traditional 401k. Even if you're not contributing to it, your company's matching contributions are going in pre-tax. Over time, you are slowly but surely accumulating a large pre-tax asset if you're using a 401k. So how does it actually work is essentially what you are doing is taking a sum of money from your traditional IRA balance and moving that sum of money into your Roth IRA. And when you make that move, it's just simply a transfer from the traditional to the Roth. You are now adding a portion, whatever that transfer is dollar-wise, to your tax return at the end of the year as if you made that income. So the question thereafter then becomes, where do we pay the taxes from? And this is oftentimes when clients have two choices, and those choices really depend on their age and what their overall balance sheet looks like. So options there are pre-59.5, post-59.5. Michael, tell us a little bit about the differences. Why is that number important?
So the reason why age 59.5 is important is right now the IRS has it set up to where anyone can take a distribution from their retirement accounts thinking IRA, Roth IRA, 401k, 403b, without being hit with an early withdrawal penalty of 10%. Okay, so that's the first marker that we need to be mindful of. For anyone who is pre-age 59.5, when conducting a Roth conversion, that is going to be treated as taxable income. When you get to the end of the year and you're filing your taxes, you want to be aware of, well, what's my potential increase in tax liability? And this is where you're going to want to work with your CPA alongside your trusted financial representative in order to forecast what that potential increase in tax liability might be that you're going to have to cover either through savings or some other form of liquidity on your balance sheet. Now, for someone who's post 59.5, it's very similar to pre 59.5. However, you now have another option. The other option would be through that conversion, because you're over the age of 59.5, you don't have to worry about an early withdrawal penalty of 10%. You can actually have state and federal taxes withheld on that conversion, right? And again, you're going to want to work with your CPA or trusted financial representative to be able to calculate how much withholdings you should include so that at the end of the year, when you file your taxes, you're not caught off guard. And if there's any sort of excess tax liability that's due, then again, you would want to be able to cover that from any sort of liquidity or savings that you have on the balance sheet.
Sure. So what I'm hearing is if you are under the age of 59.5, it makes most sense or is really most prudent to simply pay for whatever the taxes are going to be on that conversion from your savings account, from another investment account, from liquidity somewhere. If you're above 59.5, you could withhold money on the conversion. But the answer as to whether I should withhold or shouldn't withhold is oftentimes it depends.
So Brady, the big question that I think we should address for the listeners is, when should we consider conducting a Roth conversion?
I think the general rule of thumb is the earlier that you can get money into the Roth, the more time that it has to compound and to grow completely tax-free for future income, right? Engineering a more tax-efficient retirement. So the encouragement that we give a number of our clients or for anyone that we speak to is, hey, if you have the opportunity now, convert as much as possible now, knowing that the earlier, the more often, the longer that you have to grow, the better your situation may look. For some clients, they've spent a number of years contributing to a traditional IRA. For some clients, they're now at this impasse where it's time to start making these decisions. And this is where more so we focus on what considerations are important before making a conversion. I think one that you've mentioned so far is tax predictability. This idea of, hey, I'm interested in making a conversion this year. And in doing so, I've got a pretty good understanding of what I'm going to pay in taxes before the conversion, what I'm going to pay in taxes after the conversion. Does it make sense to do it now or to wait another year, another 3, another 5 years? Right? Another big consideration is oftentimes life event predictability. Am I expecting a big raise this year? Am I expecting my business to sell this year? Am I expecting an inheritance of some kind that may push my tax bill up in the future? That may be premise or onus to doing conversions now or later, right? Depending. And then the last one, as we just discussed, it's liquidity. For clients who are under 59.5, and this is a real strategy consideration for them, the biggest question that we oftentimes ask is, hey, if we add another $10,000 to your tax bill this year, come next April, do you have the money on hand outside of your emergency fund or really your reserve cash to pay the tax exposure now? Right? If you don't have the liquidity to do so, it may be a consideration to pause or to wait. And the big call out on any one of these conversions is if or once you do a Roth conversion, there's no takebacks, there's no reverses. Roth conversion happens, it's done no matter what happens at the end of the year. So the big consideration in timing is oftentimes looking at, hey, it's getting close to year end, nothing super unpredicted or significant going to happen or likely going to happen in the last month of the year. Now is the time to really add up the earnings that we have, our expected tax bill, and make a conversion of some kind.
Gotcha. And I know one thing that we implement within our client relationships is reaching out to them proactively when we get to early to mid-November to say, hey, let's pick up where we left off the conversation of potential Roth conversions for those who are interested or those who we felt like it would be beneficial for. And let's run a couple forecasts just to see where things might land from a predictability around tax liability.
Yep.
Now, as far as the potential benefits of a Roth conversion, so we've been highlighting them, right? There's a ton of benefits that we could dissect, right? And one of the biggest ones that we continue to harp on is just the long-term tax-free distributions, right? The tax-deferred growth that is tax-exempt. Talk to me a little bit about other potential benefits that you have found clients receive.
Tax-free growth is a big one. Again, this idea of engineering what your tax ride looks like as you're retired. Another big benefit is avoiding what we call required minimum distributions. So a fun fact that the IRS perhaps does not tell you while you're contributing to your traditional IRA, or a fun fact that a lot of individuals just don't really seem to find, is that come age what is now 73, what will soon be 75, the IRS requires, if you have a traditional IRA or 401k, requires you to take money out every single year and pay taxes on that money every single year, regardless if it's something that you need to do or want to do. So again, they're just forcing you to pay taxes or accelerate what is the tax bill that they will eventually collect. With a Roth IRA or through making Roth conversions, there's none of this RMD exposure. You won't have to take withdrawals unless you need to or want to, depending on your lifestyle.
So what I'm hearing is that you have greater control and flexibility of how you get to utilize and spend your retirement dollars that you've worked so hard to set aside for yourself, right? Without having to be orchestrated or controlled by the IRS.
Absolutely. Yep. Another big one in that same light is this idea of increased liquidity in retirement. The example that I often share with individuals having this conversation with future you is, well, hey, you have $1 million in your Roth IRA. It's completely extra. You've got $1 million in your traditional IRA. Completely extra. Does not contribute to your lifestyle income. And you are interested in purchasing a vacation or beach home for your retirement. Which account might you take the money from? Well, what we find is if a client wants to take or make a big purchase from their traditional IRA, they're oftentimes hamstrung or can't take that big withdrawal for the purchase because it's going to increase their tax bill exponentially when a large draw comes out. In a Roth IRA, that's not the experience. I can take all $1 million out of my extra account. I have more of this tax-free liquidity to go use for the things that I want to or use for the things that I need to at that time. So big ones are controlling your lifestyle needs, your retirement journey, and just giving yourself more options when it comes to, hey, what decisions can I make?
Right. And another way of thinking about that great example you gave is if I have $1 million in my traditional IRA that's pre-tax and $1 million in my Roth IRA, I truly have $1 million to spend freely like you presented in that Roth IRA. But with the traditional pre-tax IRA, I technically have some sort of share with the IRS. And, if we use the example of a 25% tax rate, then I only get to really spend about $750,000 of that. And the other $250,000 is earmarked over time for the IRS, right? Like that shouldn't sit well with you because it doesn't sit well with me. But this is almost the myth that is being presented in society with personal finances that, hey, you should be taking that tax deduction this year and not worry about the Roth contributions or Roth conversions because this idea of, hey, my lifestyle is going to be either lower in retirement or I'm going to be in a lower tax rate when I hit retirement is almost a fallacy, right? And we see it all the time is that when clients transition from earning income and working to living on a fixed retired income, their lifestyle is almost technically the same. And a lot of that is indicative of where the asset's coming from. Is it coming from a pre-tax IRA or is it coming from a Roth IRA? Well, if it's coming from a Roth IRA, you're probably going to be in a lower tax bracket, right? Because it's not taxable. It's not treated as ordinary income. If you're pulling it from a traditional pre-tax IRA, guess what? It's 100% taxable as ordinary income. So now your lifestyle or what you're paying in taxes is probably going to be relatively close to what you were paying pre-retirement.
Yep, you're virtually in the same tax bracket. If I'm living off of $200,000 of earned income while I'm working and $180,000 of retirement income from a traditional or pre-tax bucket while I'm not working, my tax ride's going to look and feel the exact same. And the other challenge is, hey, over the next 20 years, if the IRS decides to increase taxes, I end up being the benefactor of that true risk there. Right, is, hey, now my tax bill has gone up and my liability has increased in years where I can't do much about it anymore.
Got you. Now, are there certain strategies that one could implement in order to maximize the Roth conversion?
So I think there's a few strategies to think through, and a lot of them oftentimes are just scenarios where a conversion makes more sense in certain years rather than others. So there's this idea that I want to make a conversion and the effort of that conversion produces little tax impact as possible, right? Wouldn't it be fantastic if I could find a way to make a $10,000 conversion this year and not pay any additional tax to do it, right? It's that thought or those strategies. So scenarios or easy ones that we oftentimes find where those strategies present themselves are low income years. In years where I have taken time off work, either by choice or perhaps by circumstance, I'm between jobs, my income isn't as high, it presents an opportunity for me to make a conversion and leverage that lower working income when I add the Roth conversion income on top of it. That's one example, right? Another example of tax planning or scenarios to consider is, well, can I use a potential market slowdown or market downturn to harvest some losses out of my investment account and use some of those losses to offset my income or offset other gains that I'm experiencing, and then use that bucket or chunks worth of money to make a conversion.
And as far as, someone who, let's just say, retires at age 62, they might also be able to consider doing a staggered Roth conversion game plan where we say, hey, let's take a look at where your traditional pre-tax IRA balance is today, and let's also highlight when your required minimum distributions are supposed to kick in. Depending on what that runway looks like, you might be able to start to convert equal parts across that time horizon, right? So let's take someone who's retiring at age 62, and let's just say that their RMDs kick in at age 73. They technically have about a 10-year runway to do or conduct Roth conversions to try to shift as much of their retirement assets from pre-tax to tax exempt, so that when RMDs, required minimum distributions, kick in, they have a less of a commitment with the IRS for how much they're required to withdraw, if any at all, depending on how aggressively they want to convert.
And I think another one to look at too are for clients who find themselves charitably inclined. We'll do some of this with our more complex client cases where is there an opportunity to make a Roth conversion alongside a charitable contribution of some kind, right? A donor advised fund being a good example. Hey, can I make a larger contribution to an advisory fund that gives me a charitable write-off, right? Lowering my taxable income, and then making a Roth conversion that exact same year, in efforts just bunching this dual strategy, again, to lower the tax impact that I have this year so I can make a bigger conversion than I otherwise would have, offsetting the tax liability. A great way to increase future tax-free income or future legacy vehicles.
Now let's talk about a couple real-life examples and case studies. And what I want to do is I want to walk through two different scenarios. The first one is a husband and wife under the age of 50 with 4 children. And let's just say that as a household, that they're earning about $100,000 a year. They're saving at the EWB status, right? Hitting the right percentage of their annual growth income on that extraordinary wealth builder journey. And they are maxing out Roth IRAs annually, right? So they're hitting what that annual limit looks like, which today is $7,000 for anyone under the age of 50. So if they're earning $100,000, their taxable income is actually $70,800 after taking the standard deduction of $29,200. Okay, this puts them into the marginal tax rate of 12%. Okay, so what we're talking about here is the IRS tax tables based on how they filed their taxes, married filing jointly. Their effective tax rate, what they actually pay in taxes from a weighted average perspective, is 8.03%. Okay, so the total estimated federal tax liability right out of the gates is $8,032. Now, this couple, we discussed converting $40,000 total from each of their pre-tax IRAs. So we're doing $20,000 each. If we do this, it's going to push their taxable income portion from $70,800 to $110,800. Okay? Because again, that $40,000 conversion is treated as ordinary income. Well, what does that do from a marginal tax rate perspective? Well, it's going to push them from that 12% marginal tax rate into that 22% marginal tax rate. So we're going up the marginal tax rate table. From an effective tax rate perspective, it pushes them from 8.03% to 10.34%. So not a significant increase in overall effective tax liability, right? We're looking at about just under 2.5% increase. Estimated federal tax liability increases from a little over $8,000 to almost $14,500. In this scenario, one of the things that we would need to be able to prepare for is the tax liability increase that we would need to cover, being that they're under the age of 59 and a half. Now, with that being said, those $40,000 are going to grow tax exempt moving forward. And one of their biggest objectives was, hey, by the time that we decide to retire, we want to try to have 100% Roth dollars so that we don't have to worry about the IRS eroding our future retirement assets.
I think the big call-outs that you made were fantastic, right? Hey, we're under 50. So depending on their age, they could have 15 years or more worth of time to really see that compounding effect of the tax-free dollars. And the other big call-out is, hey, my tax bill is going to change by $6,500, give or take dollars. I have to have the money somewhere else to pay for it, whether it's in a savings account, investment account, or elsewhere. In this instance, could be a great strategy for these clients. Even those clients that are in a lower tax bracket now at 12%, moving into higher tax bracket 22, there's still a really good opportunity to engineer that tax ride later.
Absolutely. And another way of thinking about that is that you're exchanging an increase in $6,500 in tax liability today in exchange for about $33,500 net of that tax liability and tax-exempt growth that's going to compound over the course of the next 10, 15, 20 years and potentially beyond, depending on what overall income needs look like when they exit the workforce.
Michael, let's talk about scenario 2, because this is the scenario that I love to at least show and share what the effects of a conversion might look like. And I think oftentimes this is the scenario where we get way more pushback from potential clients and saying, well, why would I make a conversion in the years where I'm making what might be the most money or more money than I might need in retirement? Right. So if we walk through it, single physician earning $250,000 per year, and this individual is saving 20% of their income in that extraordinary wealth building clip. And this individual has subscribed to the Roth IRA or the Roth bucket of money being more powerful in retirement. So they're making all of their contributions to their Roth 403B, right? Annually, call it $23,000. In this particular year, their taxable income is $235,400, knowing the standard deduction is $14,600, right? Their marginal tax rate is 32%. I'm in one of the higher, not the highest, but one of the higher tax brackets compared to perhaps many of my peers, especially filing as a single individual. Their effective tax rate is 21.21%. Essentially, every dollar that they bring in is being taxed at around 21%, and their estimated tax liability is $53,015. So potential idea in this scenario is knowing that as they've been making contributions to their Roth 403B, all of the match that their employer has been putting in is pre-tax, right? They're accumulating a substantial pre-tax bucket over the years and with growth because the employer is not giving them the Roth option on matching. So idea is to convert $30,000 of money now to a Roth IRA, assumption being we've got a runway before retirement. Right, if we convert $30,000 this year, it moves our taxable income from $235,400 up to $265,400. Not crazy, just adding $30,000 to our income, still making Roth 403B contributions, still doing all of the rest of our savings. We've actually increased our marginal tax bracket from 32 to 35. We've broken through that threshold. This is the argument, right? Why would I pay more in taxes or increase my tax bracket now? The interesting note in this scenario is the effective tax rate has only moved from 21.21 to 22.59. Call it 1.4% in total, moving estimated tax liability from $53,000 up to $63,265. In scenario 2, we've made a $30,000 conversion when or as this person's been a high earner. We've barely increased the effective tax rate, the actual tax that they'll pay. We've covered our taxes from a liquid bucket, that additional $10,000 from somewhere else, and now this person has an additional $30,000 compounding, doubling, tripling, quadrupling before they reach retirement, right? And none of that tax risk later, what bracket am I going to be in, how are taxes going to adjust, affects this person.
And just to be clear, everything that we're presenting today is based on current IRS tax code, right? Could things change in the future with Roth IRAs? Potentially, right? We can't control the outcome of the future, but why not try to take advantage of what's available to us today as we continue to optimize our financial balance sheets and improve our overall financial fortitude? Now, Brady, talk to me as we start to wrap things up, the impact of converting during different stages of life, right? Like we've talked about early career, we've talked about peak earning years, right? In that example that you presented in scenario 2, as well as even retirement. What does that impact look like over time?
I think in simple terms, as we've discussed up to this point, the earlier you make conversions, the more of an impact it has on your retirement tax journey, right? If you make a conversion when you're 30 years old, you have the next 30 years to see those dollars compound. If you make that conversion at 60 years old, there is still certainly a potential benefit there, but the time it takes or the time that you have for those dollars to compound just isn't the same. So it's really about assessing, hey, how am I using, when am I using this money? How much of a runway do I have? And ultimately, where is the benefit, or what might the benefit look like? And that's something a financial professional representative can essentially help you with, alongside of a CPA and your tax professional.
Got you. Now, as we wrap things up, we cannot overlook the common mistakes that occur for individuals who try to go and DIY this or conduct these Roth conversions themselves, right? Like there's often things that are overlooked in the excitement of completing a Roth conversion. So what do we need to do to be able to avoid these, right? And one of the things that comes up is just mismanaging the time of conversions. So one of the things that you need to be aware of is that the conversion has to be completed, has to be done by December 31st of each year. So make sure you give yourself some grace. Try to get it done, by December 15th, a little after that, because you have the holidays coming up. And what that means is that institutions are going to be closed. Their staff are going to be taking time away to be with family and friends and just enjoying their time, right? So make sure you give yourself a little bit of a runway to make sure that everything gets completed quickly.
In that same light, I think it's important for individuals to consider not to do these conversions too early in the year, right? As important as it is not to do this December 29th, 30th, 31st, I think it's equally important not to take care of this on your New Year's resolution list January 2nd, 3rd, or 4th, right? Again, there's no going back. There's no reversal on making a conversion. It's now a forever choice. So the things that we hate to see is someone who just got real excited about making a conversion and implementing this strategy, just to find 12 months later that, hey, this may have been the worst possible year to do it, with a capital event, a life change, a tax change, etc.
Another consideration or something to avoid is just failing to consider the long-term impact and future tax rates, right? Like we've been harping on the tax efficiency of this and the opportunity at hand. This is a scenario where we feel like, and this is our own opinion, that you should have a sense of FOMO, right? Fear of missing out on being able to optimize your financial fortitude. Why not highly consider a Roth conversion at any point in time in your career, as long as you do the due diligence just to make sure that it's within reason, right? That it's not going to be inefficient for you. And one thing that we could look at, or at least reference when looking at just the historical IRS tax tables presented online, is that if we go back to 1945, the highest marginal tax rate was actually around 94%. And the lowest was around 23%. Today, the highest is what, Brady, from a marginal perspective?
39%?
And the lowest is what?
12%. Call it maybe even 10%, really depending.
Correct, 10%. So just consider that. Those are massive shifts down from a marginal tax rate perspective. So again, if you're going to do a conversion, why not do it during a period of time where historically federal tax rates from a marginal perspective are at a lower capacity?
Yeah, everyone talks about diversifying risk when it comes to the mix of stock and bonds or what stocks that you have in your portfolio. There's also a huge diversifying factor of really controlling what your own tax situation looks like, knowing that you don't have control of future tax rates.
Correct. And then another big one is that with every conversion that you complete or conduct, that portion is subject to a 5-year holding period for each conversion. And so what that means, we didn't really dig into it specifically today, but a lot of individuals will like to consider their Roth IRA as a bucket of liquidity pre-59.5. Based on the rules of how these accounts work, account holders are eligible for withdrawing up to their principal balance pre-59.5 without any sort of early withdrawal penalty or taxes, right? Because it's return of principal. This is where it can get very hairy if you're going to commingle a future long-term retirement account with your everyday ATM account, in the sense that you're viewing it in the same manner. We truly believe that Roth IRAs should be treated as long-term retirement buckets with tax efficiency. We're trying not to take distributions from this account pre-59.5. We don't have to, right? Because if we're going to be conducting Roth conversions on an ongoing basis, we're now having to keep track of which portions are going to have that 5-year holding period before they become eligible for withdrawal pre-59.5 without any sort of early withdrawal penalty.
Yep. And then I think the last one is just not really managing what that immediate tax impact looks like. Right? If I make a large conversion in December of this year, I'm going to have to turn around, call it 3 or 4 months from now, and pay my bill. right? So it's important that I have liquidity, money on the side, pre-age 59 and a half. It's important that I have enough tax-deferred assets post 59 and a half to pay the bill and not affect my other goals. And there's also this idea of I could convert too much, right? I could get really excited and convert a large portion during the middle or perhaps later end of the year, get a big bonus and push myself into a higher tax bracket when that could wash away some of the positive benefits. And it's possible if I'm making conversions post 65 in that pre-RMD plan, that making a large conversion could lead to additional what's called IRMA expenses, where my Medicare bills now go up because the IRS is showing that I'm reporting more income than I otherwise would have in the past. I think that's a conversation for a whole nother day. That's where you have a conversation with financial professional CPA to help really assess how is this going to affect my total picture.
Now, as we wrap things up, what are your closing thoughts or key takeaways for our listeners today as they continue to digest and discern whether or not a Roth conversion for this year makes sense?
I think the biggest takeaway is to have a conversation with future you, right? Whether you're facilitating that or using the help of a professional to facilitate it. What do you want your financial picture to look like, and how is your tax ride going to look? Another key takeaway is you should have FOMO when it comes to using the Roth IRA or consider a Roth conversion. Pre-engineering what that ride's going to look like, there's more advantages to doing it earlier and more often, as opposed to later or in the last minute. And then lastly, there are decisions that you need to make that have time constraints and rules attached to them, right? You have to be aware of when you should make a contribution, what rules you need to consider when making them, and you may need to have a partner or player on your team to help guide you in those decisions.
I think that's perfect. Again, it can't hurt to consult with your tax professional or trusted financial representative. And again, it's a matter of just considering where are the current marginal tax rates today, as well as your potential effective tax rate pre-conversion and post-conversion if you're going to be road mapping this, right? Don't be afraid to do the due diligence, do the research, or even consult with somebody who has your best interest in mind. Now, with that being said, we want to thank you for joining us on this episode of Financial Fortitude, where we unpacked the ins and outs of Roth conversions. We hope you're walking away with the clarity and confidence to decide if this strategy is right for you. If you found value in today's episode, we'd love your support. Be sure to like, subscribe, share, and leave a review wherever you listen to podcasts. Your feedback not only helps us grow, but also ensures we're delivering the content that matters most to you.
And if you're still wondering if you should be doing a Roth conversion this year, we've got you covered. Reach out to us at www.genesiswealthplanning.com/contact and reference the Roth conversion episode in the notes, and we'll send you a complimentary copy of our Should I Consider a Roth Conversion decision tree. This is an all-in-one guide that you can walk through to begin to get an idea of, hey, is there an opportunity for me? And until next time, keep building your financial fortitude. Thanks for listening. Thank you for joining us this week on the Financial Fortitude Podcast. We hope you enjoyed the show and learned something along the way.
If you're looking for financial guidance that is personalized to your specific needs, we're here to help. Visit us at www.genesiswealthplanning.com to book a complimentary consultation.
That's it for today. Make sure you subscribe so you don't miss out on future episodes. And as always, please share with others you feel could benefit from the show. See you next time.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific specific investment advice. Michael Acosta and Brady Hemmerly are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerly's California Insurance License Number 4353077.
6991809.7. Expiration 1226.